This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Alright, we're still talking about currency options, and in the last lecture, in the previous lecture, I explained over-the-counter options, which you should have found very straightforward. But then as far as traded options are concerned, which is more common in the exam, I explained that table of option premium, because half the problem is actually working out how much an option is going to cost us. So now let's see how we can actually use it. If you look at example 3 with me, a UK company owes a US supplier 1 million payable in April. So we're going to be paying $1 million. We need to buy $1 million. The spot rate is 1.4850 to 1.4870. And we're concerned the dollar might strengthen, that the exchange rate might move against us. We want to use options to fix a worst outcome. Traded options are available as shown in the following table. It's the same table as before. And I've explained the terms, but all those figures within the table are the premium. And we're going to do two things. A, we're going to show how traded options can be used to hedge the risk at 1.475. So for part A, we're going to decide what options we're going to go for and how much they'll cost. And then in part B, I'm going to show what actually happens when we get to April. The spot rate in April could be anything. We're going to show what actually happens if the spot rate has gone to 1.41 to 1.4120. So off we go. First of all, let's work out what options we're going to buy and how much they'll cost. All right, and make sure this stands out clearly for the marker, because each bit you get right here will be attracting marks. We need to calculate the premium payable. We need to know several things. We need to know, first of all, what exercise price. That obviously affects the premium. And here, although there were 3 available, the question specifically says he wants to hedge the risk at 1.475. So that's the strike we're going to go for. I'll talk afterwards about what to do in the exam if they don't tell you which strike price to choose, but here they did. So there's the exercise price. We also need to know, do we want put options or call options? Well, remember, we'll choose, or how we choose, depends on whether we're buying or selling the contract currency. The contract currency here, the contracts are 31,250 pounds. So if we want the option to buy pounds, it'll be a call option. If we want the option to sell pounds, it'll be a put option. Well, what happens here? The transaction itself, sorry, I'm writing down how my brain's working. The transaction, we owe a supplier $1 million, so we'll need to buy dollars. How will we buy dollars? We'll buy dollars from the bank by selling pounds to the bank. Pounds are the contract currency. Contracts are quoted in pounds. Therefore, we want the right to sell pounds at a fixed price. And selling pounds at a fixed price, well, it's a put option. So we want a put option on pounds. What else do we need to know? Well, we need to know what month. Is it March, April, May? Well, we need the money in April. We'll therefore go for April puts. Now it says in April. However, European, I mean, these will be European, but we ignore the fact it might not be the end of April as far as the exam's concerned. So there we are. We want an April put at 1.475. However, and as a result, what will the premium be? Well, that's just using the table. The puts, April 1.475. I get 1.20, which, as I said in the last lecture, it means they'll charge us 1.2 cents for every pound. But we've got a problem. Well, it's a problem we can solve easily enough. First of all, we want the option on $1 million, but the premium is quoted on pounds, so we do need to convert to calculate it. But secondly, whatever the pound equivalent is, it has to be in fixed size contracts. As always, you're given the contract size, and here it's 31,250. So, need to do a little bit of work. For the contract size, the number of contracts. Oh dear. Ideally, we want the option on $1 million. Well, because contracts are in pounds, we need to see how many pounds is that equivalent to. Well, at our exercise price of 1.475, it's equivalent to $677,966. And so the right to sell, we want to buy $1 million. Well, it's the same as the right to sell £677,000 at the exercise price. So that's the amount we want the option on in pounds. It's got to be in these fixed size contracts of 31,250, and therefore 677,966 divided by 31,250. I get 21.69 contracts. But just as with futures, and I've already said it anyway, it's got to be in whole numbers of contracts, round it to the nearest contract. And so we'll go for 22 contracts. And it's, of course, it will mean we've not got the option on precisely the amount we want because of the fixed size contracts. Finally, we can now work out the total premium . And the total premium, we've got the option on 22 contracts, each of £31,250. Now, I'm not going to multiply that up and write an answer, it's wasting time, but however many pounds that comes to, a bit more than that obviously, the cost will be, what was it, 1.20? Yeah, 1.20 cents for every pound. And so how much does it come to? 22 times 31,250 times. Well, 1.20 cents, remember, is $0.012. It comes to 8,250. Remember, the premium are quoted in cents, so 1.2 cents again is 0.012 dollars. No problem. All right, not there yet, I'm afraid, for part A. That's the premium we'll have to pay, but the premium's calculated in dollars. We're in the UK, and so we need to convert it to pounds. And what rate will we convert at? Well, remember, the premium is payable immediately. It doesn't say the date, but anyway, the premium is payable now. And so to calculate the premium in pounds, we'll convert to today's spot. So A250, it's dollars. We'll need to buy dollars to make the payment. The dollar buy rate is 1.4850. And so finally for this bit, 8250 divided by 1.485. The premium is 5556. So there is the premium. It's payable again immediately. And it's payable whether or not we exercise the option. So as always, it's taken me a long time to speak through that. But when you've practiced a bit, it should become pretty quick. But there we are for part A. We're going to buy April put options at a strike of 1.475. 22 contracts. And as a result, the total premium we'll have paid is 5556. Let's finish it off though, because the question, as in the exam, usually almost always wants you to carry on and shows what happens for any particular spot rate. Well, it says the spot rate in April when it comes to the transaction is 1.4100 to 1.4210. And when it comes to April, it's our choice whether to exercise or not. Well, which are we going to do? First of all, which is the relevant rate for getting the option? Surely we need $1 million. $1 million, if we weren't using the option, we would convert at the dollar buy rate. We'd use 1.4100. Now watch very carefully what we do, because it looks very strange here. First of all, whatever happens, we convert the transaction at spot. Initially, forget the option completely. And if we convert at spot, how much would it cost us? It's $1 million. Convert at 1.4100. And so in pounds, 1 million I get 709,220. So we've converted at spot. We then say to ourselves, is it worth exercising the option or not? If the strike price is worse, we'd throw away the option and that would be the end of it. We'd pay 709,220. It's a payment, remember, you're buying dollars. If the strike price is better, we'll exercise the option. Well, what we do here, our option was the right to convert at 1.475. And of course, it's better to convert at 1.475. But the option was only on however many contracts we went for. I'll check back in a minute, 22 or whatever it was. And so the way it works is this. I've already said if you're not exercising the option, that's the end of it. If you are exercising the option, which we will do here, with traded options, remember, we have the right to convert at 1.475. The spot rate is better, it's only 1.41. Well, with traded options, we claim back the difference from the dealer. And so by exercising the option, we'll get back on however many contracts we went for, we'll get back the difference between the exercise price we paid for and the current spot. Well, how many contracts was it? It was 22 contracts. What was the contract size? It was 31,250. We've got the right to convert at 1.475. The actual rate is 1.41. And so we claim back from the dealer the difference between them, 1.475 minus 1.4100, which comes to how much? It comes to 44,687.5. So that's what we're claiming back from the dealer, except of course it's in dollars, because we bought the right to convert at 1.475 dollars to the pound. The actual rate is 1.41 dollars to the pound. And so we're claiming back that difference of 0.0650 dollars on every pound. That's how much we're claiming back, but of course because it's in dollars and we're in the UK, we need to convert back to spot at whatever, back to pounds, or whatever the current spot is. And what is the current spot? Here we're selling dollars to convert to pounds. It's not on there on the question. The spot for selling dollars is 1.42120. So the exchange rate 1.4120, it converts to what? $31,648, and that's a receipt. So do see what's happened here, please. We converted the transaction at spot. 709,220. Because spot was worse than the rate we'd agreed, the exercise price, well, we can't convert the transaction at the exercise price. We'd only got the option on a fixed number of contracts. So because it's gone worse, we claim back from the dealer the difference between the two rates, strike price and spot rate. We claim back that difference on the number of contracts. 22 contracts, £31,250 each. Claim it back, it was $44,000. Convert back to pounds, whatever the spot is, 31,648. And what does that end up giving? 709,220 minus 31,648. It gives a net amount of 677,572. A net payment to end up with our $1 million. Well, there's the net result, except of course, just like with over the counter, whatever happens, whether I'd exercised or not exercised, there was that premium payable. We worked it out earlier, it was 5556. Again, it's a payment. The premium's always a payment. And so the very final overall result, there's a total payment. £677,572 plus 5556, 683,128. And there we are. Now I have a few things left to say about this. As far as the exam's concerned. But there's the way traded options work. The exact amount of the transaction is at spot. Had spot been better than the strike price, obviously we wouldn't have exercised the option, but the premium would still have been payable. But because the exercise price, the strike price, is better, claim back from the dealer. And I know it's a little bit messy, but based on the number of contracts. All right, that's it. As far as the exam's concerned, various things. Firstly, I've already said, in the exam you're given generally 2, maybe 3 strike prices. Usually it's only 2. But in the exam, he's unlikely to specify which exercise price to go for. He'll just say, show how traded options can be used. And if that's the case, ideally for full marks, you would illustrate all 3 strike prices. I've done it at 1.475, but you'd also do it at 1.45, at 1.425. Now that obviously takes time, although to be honest, when you've done one, it then gets a bit quicker. You know, number of contracts stays the same generally and that sort of thing. So ideally do all 3. Excuse me. However, the examiner's not stupid, and neither are the markers. What they're really after is for you showing you know how options work. So if you've got the time, do all of them. I say it's usually only 2, so you're only doing it twice. If you are running out of time, then simply doing one of them would get most of the marks. You know, do one and just doing writing, you know, there are 2 others available. So I hope I'm making sense there. You know, your job is to pass the exam. If you've got the time and you're happy, do all 3. Otherwise, make sure you've done one in full and then just say that others are available. Also appreciate you can only go through and show the whole calculation if you know what the spot rate is on the date of the transaction. And when it's options, you usually are told, as you are here. If you're not told, then you can't go through and do the whole thing. You can't. You need to know what the spot rate is. In which case, he'd expect you to be able to calculate the premium. But since you can't actually illustrate what happens on transaction date if you don't know the spot, it would then be a question of just explaining in words that when it comes to the date of the transaction, you've got the choice, and explaining in words what would happen without actually doing it. All right, so I know that's a bit messy. I probably made it seem more messy than it actually is, to be honest. I hope not. But just quickly, 2 more things to mention on the final page. But as you'll see, no calculations here. One thing, and it's completely different from everything else we've done, is currency swaps. And don't worry, it won't take me many minutes here. I'm not doing any arithmetic, and I'll explain why. But a currency swap is this. Suppose I'm in the UK, but I want to borrow dollars. Why? Maybe I'm about to do a big investment in America. I'll be spending dollars. And for reasons I explained at the very beginning of last chapter, it would be quite sensible, if I'm going to get dollar income in this other country, to have borrowed the money in dollars and be paying dollars interest. But for whatever reason, I want to borrow dollars. The only problem is I can borrow dollars in the UK, but I'll probably pay higher interest, than I would be if I was borrowing pounds. Suppose, though, I find someone else, who's in the US, who wants to borrow pounds. Obviously, if they're in the US, it's not a person, a company, but still, if they're in the US, they normally would borrow in dollars, but perhaps they're going to invest in the UK, they want pounds, so they're paying interest in pounds. Now, this is all to do with credit ratings and things. I'm in the UK, it's probably going to cost me more in interest terms to borrow dollars than it would cost someone in America. Someone in America can probably borrow dollars cheaper than I can. And equally, because I'm in the UK, I can probably borrow pounds at a lower interest rate than the other person. So instead of doing our own borrowing, I borrow in dollars and they borrow in pounds, we can potentially save interest if I borrow in pounds, the other company borrows in dollars. If we borrow money in our own currency, we're likely to be paying lower interest. And then we swap the interest payments. Because we're both paying lower interest than we would if we borrowed in the other currency, borrow in our own currency, but then the other company pays my interest, they're paying in pounds, I pay their interest, I'm paying in dollars, which is what I wanted. Now, if you're wondering exactly how that can work, it's effectively what we call an interest rate swap. And I'll show you numbers on that when we come to interest rate risk. And I will then refer back to currency swaps. And you'll see exactly what I mean and how the numbers could go. Finally, I'm certainly not worried. I think I should have cut this out. It's only ever been mentioned once, something like 2 marks at the end of a question. But a swaption is where you want to do this swapping, but instead of wanting to do it today, you want the right to do it in the future. So swaption is having the right to swap, but on a future date. And there'll be a premium. But I really wouldn't worry about swaptions. I say it's only been mentioned once, and there couldn't possibly be arithmetic. All right, so that was rather a long lecture, but anyway, we've got it out of the way. That's everything you need for foreign exchange risk, this and the previous chapter. The other big one, but it shouldn't take us long because the principles are similar, is dealing with interest rate risk. But that's the next chapter.